The market continues to climb higher in 2025, and high-quality stocks continue to grow earnings and free cash flow, and as a byproduct, they're increasing their dividend payouts, speeding up the dividend snowball effect. So in this video, we're going to be looking at 6 different dividend stocks that just recently announced dividend increases. Let's go ahead and dive into it. Now, the first stock we're going to be looking at is Kroger. Kroger just announced a 9.4% dividend increase. That's a very solid dividend hike, and if we look at them on Seeking Alpha, Kroger's been one of those quietly very good dividend stocks over the last year, up 33%, and in the last 5 years, up 102%. And during this time period, if we look at what's been going on with their dividend payouts, we can see they've grown at a very high rate. In 2019, that dividend payout was only around 60 cents per share, and as of 2024, it had more than doubled, currently sitting at about $1.28. So while the starting yield is about 1.8% as of right now, because they've been growing that dividend so fast, your yield on cost continues to climb higher and higher. Now, the free cash flow payout ratio right now is sitting a little bit below 50%, and one of the things we do have to make note of is Kroger's free cash flow has fluctuated quite a bit over the last few years. Now, 2020 was a huge spike, and it's come back down a little bit, but over the long term, especially since 2016, 17, and 18, we're still seeing a positive trend in free cash flow, but this is something to make note of. Now, if we jump over to our stock screener, come up here and look at Kroger, you can see while free cash flow has fluctuated a little bit, for the most part, revenue stayed relatively steady. Now, it's stagnated a little bit over the last 3 years. But one of the things we can make note of is if we jump back over to Seeking Alpha and look at earnings estimates for Kroger over the next few years, they're still projecting around 7 to even 10% earnings growth. So earnings are projected to continue to grow, and with a healthy free cash flow payout ratio sitting about 50%, we should see this streak of dividend increases continue. Now, as for the valuation, what we can see is Kroger is trading at a free cash flow yield of about 3.61%. Basically, what that's telling us is based on the trailing 12 months free cash flow, if we invested $100 into the stock, it would produce about $3.61 of free cash flow. Now, the 10-year average for the stock is about 6.31%, so it is trading at a bit of a premium compared to how it's historically traded, but keep in mind they have been growing free cash flow recently faster than they have in the past, which typically warrants a higher valuation. Next on our list is Union Pacific, and they just announced a 3% dividend increase. And if we look at the last year, they're actually down by about 5.5%. Now, this company's been in the news in the last few days due to one major reason. Union Pacific confirms deal for Norfolk Southern to create the first U.S. transcontinental railroad. This would connect over 50,000 route miles across 43 states and nearly 100 ports. And this would be around an $85 billion deal. Now, with that being said, I don't think this is guaranteed yet. We can see the unions are already opposing this deal, and along with this, rail customers are already telling regulators to look into blocking this deal. Now, if we look at UNP from a dividend perspective, we can see another stock with a nice history of a growing dividend. The starting dividend yield is around 2.41%, but the 10-year dividend CAGR around 9.31%. That's a fairly decent combination, and the free cash flow payout ratio has remained relatively stable at around that 50% mark. Now, one of the huge competitive advantages for UNP is the fact that there's extremely high barriers to entry in their sector. A company can't just build a railroad overnight. That would be extremely time-consuming and capital-intensive. So one of the things investors love about this stock is the predictability of the cash flows. This isn't a high-growing stock, and nor will it be in the future, but there is a lot of predictability. Now, one of the things you will notice is revenue per share and free cash flow per share for the last 3 or 4 years has been a little bit on the stagnant end, but here's the good news potentially for UNP. If this acquisition does go through, it's estimated they would be doing over $7 billion in free cash flow. So for reference, we can see in 2024, they did about $5.89 billion, so this would certainly boost free cash flow by quite a bit. But first, I'd like to say thank you to Mumu for sponsoring this video. Mumu is your one-stop global trading platform with over 37,000 listed companies' financial data and over 26 million global users. And while Mumu does have $0 commissions on stocks, ETF, and options trades, it's much more than just a brokerage. With Mumu, you can read market analysis, you can see things like the heat map, and you can utilize stock screeners either with your desktop or with the mobile app. And one of my personal favorite features is the institutional tracker. For example, we can look at Warren Buffett's Berkshire Hathaway and look at what he's holding in his personal portfolio as well as seeing his latest buys and sells. On top of that, you should definitely take advantage of their earnings calendar, where you can see a list of the most important stocks getting ready to announce earnings in the upcoming days and weeks. And for a limited time, you can actually get an 8.1% APY for the first 3 months on your uninvested cash. And along with that, you have the potential to get $1,000 in Nvidia stock if you deposit $50,000. So check out Mumu at the link in the description to get up to $1,000 in Nvidia shares with qualified deposits. Next on our list, we have JP Morgan. Now, they announced a dividend increase after they announced very nice results against the recent stress test. And on top of the dividend hike, they announced a new stock buyback program. Now, what we can see is the dividend hike is going from about $1.40 per share to $1.50 per share. But here's what we have to make note of when we talk about JP Morgan. If we look at the dividend history for this stock, really in the last 3 years or so, you'll notice something interesting. They've actually been increasing their dividend every 2 quarters for the last year or so. So things are going really well for JP Morgan right now. It's pretty rare that you're going to see 2 dividend hikes in the exact same year from this stock. But this most recent one came in at around 7%. Now, JP Morgan's been doing just phenomenal over the last few years. In the last year, up 41%. And in the last 5 years, another stock that's quietly just been crushing the market, up over 200%. And this is actually a stock that I own in my personal portfolio, and I've definitely enjoyed the gains. I'm currently up close to about 181% on my JP Morgan position. So if we go and jump over to our stock screener and look at JP Morgan, we can see that yield is around 1.8%, but that doesn't account for the new dividend hike, which will bump this up closer to about 1.9%. But again, you can see they've really been increasing that dividend payout over the last few years with a 10-year dividend CAGR of close to around 12%. Buying JP Morgan is essentially a bet on the American economy. And so far, over the last few years, that bet seemed to be paying off quite well. And now we come to Cintas, who just announced a massive 15.4% dividend increase. And over the last year, up about 21%, and they saw a very nice jump back up after a sell-off in December. If we look at the last 5 years, up nearly 200%. So let's take a look at the dividend metrics for this one, and you'll see this is a fast-growing dividend. Now we can see the starting dividend yield is a little low at about 0.7%, but again, that 10-year dividend CAGR almost touching 20%. But here's what I absolutely love to see. When a stock can grow their dividend at a rate of something absurd like 20%, but they are still maintaining a low free cash flow payout ratio. In fact, ever since around 2017, it's stayed in that 20 to 30% range. So what does that mean? Well, it means free cash flow is growing at an incredibly high rate. Remember, if you want your portfolio to be a dividend growth machine, the holdings have to be free cash flow growth machines. Dividend growth is a byproduct of growing free cash flow. So when you see growing free cash flow like this is what enables them to grow that dividend at a high rate. Now, when we look at the dividend history for this stock, it's actually a little bit interesting. You can see right here in 2020, it looks like the dividend decreased from 2020 to 21, but that's not actually the reason why. They used to pay out annual dividends, and the timing got a little bit funny right here, but overall, dividends are growing at a very high rate. We go ahead and jump over to our stock screener. Let's take a look at CTOS. And look at just how fast earnings have been growing over the past decade, going from about 77 cents per share all the way up to $3.85. They have been buying back some shares, but it's been a little bit less over the last couple of years. But again, here's what I really love to see. Return on invested capital, one of the most underrated metrics to look at in my opinion. It's telling us how profitable are the projects the company is investing their capital into. As a baseline, we typically want to see around 10%, but the highest quality stocks can get 20%. And Cintas has slowly been trending towards 20%, getting higher and higher every single year. And in fact, in 2024, they got to about 20.9%. If we look at the profitability sheet, along with return on invested capital increasing, look at the gross profit ratio. This is one of the things I just love to see. Every single year, it's climbing a little bit higher. It's climbing higher and higher. This is a sign of a competitive advantage. They're flexing their pricing power. The 10-year average gross profit ratio is around 45.2, and last year's came in at 48.83%. So they're becoming more profitable. Return on invested capital is growing, and revenue and earnings and free cash flow are growing. So it's no surprise that dividends are growing at a rate of nearly 20%. Now we come to Mando, who recently announced a 6.4% dividend increase, so a pretty solid dividend increase. And if we look at the last year, it's down by about 7.94%. Now, in early 2025, the stock was in the midst of a huge sell-off, and that's when I really pointed out this stock over on Dividendology.com. But it saw a nice recovery, but it started to dip again just in the last few days, in the last few weeks. Now, if we go to jump over to our dividend breakdown sheet, let's take a look. And what we'll see is there is some good and there are some concerns. The starting dividend yield is nice at above 3% and a 10-year dividend CAGR at above 12%. A 3% yield with a 12% dividend CAGR is a very nice combination, but one of the things we do need to make note of is the free cash flow payout ratio has been growing every single year since 2018. So some of that dividend growth has not been backed by growing free cash flow. Free cash flow has not been growing as fast as the dividend. Now, one of the reasons this is the case is if we jump over to our stock screener and look at the profitability tab, take a look at Mondelez, and take a look at the gross profit ratio. We're starting to see some dips. Now, why is this the case? Well, one of the things we have to understand about Mondelez is they're reliant on commodities like cocoa, and the price of cocoa has skyrocketed in the last few years. It's pretty much tripled in some cases. So this is definitely taking a toll on their supply chain. Now, is this a short-term or long-term headwind? I think most people believe it's short-term, but it's still definitely a headwind for Mondelez as of right now. But I do have to say that starting dividend yield combined with dividend growth is pretty attractive, but keep in mind, this most recent dividend hike quite a bit lower at about 6.4%, which interestingly enough is much more in line with that 10-year free cash flow CAGR. And then finally, to wrap things up, we have J.M. Smucker, which announced a 1.9% dividend increase. Now, this is what I call the dreaded below inflation rate dividend increase. Why is that relevant? Well, we have to remember, if a stock is growing its dividend at a rate below inflation, then they technically didn't increase their dividend payment at all. It means this year they're technically paying out less than the previous year. If we look at SJM in the last year, they're down 9%. In the last 5 years, it's not pretty, down about 2.89%. Now, obviously, one of the upsides of a stock selling off is you can get in at a higher starting dividend yield. So, for example, we can see that starting dividend yield is around 4%. That's pretty attractive. But if we look around, there's a lot of red flags. Yes, the dividend has been increasing, but the free cash flow payout ratio has been increasing at the same time. Free cash flow has actually been decreasing, and the dividend growth rates have been slowing down. The 10 years at about 5%, but the last 5 years closer to about 4% in this most recent dividend increase, coming in at only 1.9%. And if we look at earnings expectations for this stock over the next couple of years, it doesn't look very pretty. They're expecting about a 10% drawback over the next year. Now, by 2028, they're projecting $10.38 in earnings, but to put that into perspective, if we jump over to our stock screener and look at SJM, we can see in 2024, earnings are about $7.14. They had a good year in 2018 at about $11.79. So yes, that will be a nice bump up, but it's still quite a few years away. There's still short-term headwinds. So don't be deceived by that high starting dividend yield combined with the fact they've been growing dividend. There is some red flags here. But there you go. Those are 6 dividend stocks that just recently announced dividend increases. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.